Imagine waking up on a Saturday morning, rolling over to check your phone, and discovering that you've earned money in your sleep. No alarm clocks, no commutes, just passive income flowing into your account because of one smart move you made with $25,000. Sound too good to be true? Well, buckle up, because today you'll see exactly how to turn a modest pile of savings into a stream of cash that keeps pouring in. Whether you're hard at work or lounging by the pool, we're about to unravel the real-life magic of dividend investing, not the fantasy where you instantly get rich and retire to some Malibu beach, but a strategy that transforms $25,000 into a wealth-building machine you can actually be proud of. Maybe your $25,000 feels small compared to the six-figure dividend hustlers you see on social media, but I'm here to show you how that amount can be the foundation of your own financial empire. No jargon, just the actionable steps, real numbers, and the mindsets that make the difference. Ready? Great. Let's get straight into the secrets that the internet's success stories never tell you. Let's be brutally honest for a second. You're not quitting your job tomorrow just because you invest $25,000. But what if instead, this money could start covering chunks of your expenses each month with absolutely zero work from you? On average, a solid diversified dividend portfolio yields around 4% per year. Now, I know what you're thinking. 4%? Yawn. But 4% of $25,000 is $1,000 each year. That's $83 a month. No, it won't pay your rent, but think about what it can do. It could handle your Netflix subscription, Spotify Premium, and maybe that gym membership you use twice in January. Your money starts working while you handle life. That's just round one. Because what makes dividend investing so powerful is not just that first payment, but what you do with it. Here's the secret. Every single dollar of dividend income you get should be put back to work for you. You take your $83 each month, buy more dividend stocks, and let compound interest do its magic. Dividend reinvestment is like compound interest on steroids. Start with $25,000. In a year, you add another $1,000 in dividends, assuming that 4% yield. Reinvest that, and you now have $26,000 working for you. Next year, it grows a bit more, and so on. The growth isn't mind-blowing in the first year, but with time and patience, it gets seriously impressive. People say, so what? At this rate, I'll be ancient before it makes a difference. But here's where the long game pays off. The real explosion happens when you make reinvesting a habit and contribute even just a bit more each month. Suppose you toss in an extra $200 every month. Not only are you reinvesting your dividends, but you're also pushing your portfolio to new heights. Year 1, you're earning dividends on $27,400. By year 5, you're earning on over $40,000, and your annual dividend income has shot up toward $1,600. All from $25,000 plus some monthly hustle. So how do you actually build a portfolio that's simple, effective, and lets you sleep at night? Forget collecting 50 random stocks for diversification. With $25,000, the goal is maximum results for minimum effort and minimum fees. This is why ETFs, exchange-traded funds, are your best friend. Think of ETFs as Costco for investing. Grab a basket that already has hundreds of companies that have proven they can deliver consistent dividends. For your core, consider a dividend growth ETF, like the Vanguard Dividend Appreciation ETF. This fund is designed to capture companies increasing their dividends year after year. Layer in something like the iShares Select Dividend ETF for a bit more yield, and sprinkle in individual blue-chip dividend aristocrats, companies raising dividends for 25-plus years straight, to round out your risk. Here's a sample allocation to get the gears turning. 60%, $15,000 in the Vanguard Dividend Appreciation ETF, VIGIX/VIG, focused on 10-plus years of dividend growth, about a 2.8% yield. 20%, $5,000 in the iShares Select Dividend ETF, DVY, offering a higher 4.2% yield. The last 20%, $5,000, spread across 5 individual aristocrats: Johnson & Johnson, Coca-Cola, Procter & Gamble, McDonald's, and Walmart. Let's see how it adds up. VDIGX at $15,000 and 2.8%. $420 a year. DVY at $5,000 and 4.2%. $210 a year. 5 blue chips, say 2.6 to 3.1% yields, roughly $125 a year. Grand total about $755 annually, or $63 per month at the start. Doesn't sound earth-shattering, but keep those dollars churning and things ramp up. Some people think investing has to be complicated to work. The truth? It's the simple automatic systems that win. When you use diversified ETFs for the bulk of your portfolio, you get the safety of hundreds of companies and automatic rebalancing. If one company stumbles, let's say the CEO goes on a yacht buying spree and cuts the dividend, you're still protected by all the other holdings. Plus, if you automate your investments and dividend reinvestments, it all runs in the background while you focus on life. This structure means you don't have to spend weekends researching mystery stocks or panicking over market noise. Your portfolio is built for the long haul, steady, tested, and always moving forward. Here comes the showstopper, compound growth. This is what transforms small beginnings into jaw-dropping results. Every penny of dividend that gets reinvested buys a little more stock, which then pays you more in dividends. Add to that the fact that quality companies raise dividends most years, and you get a powerful upward spiral. Let's say the companies in your portfolio boost their dividends by an average of 5% each year. 5 years down the road, your dividend income could be up to $1,400 just on those dividends alone, without you adding a cent more. Now add in your $200 monthly contributions. Suddenly, after 5 years, your portfolio has snowballed to about $45,000, and your annual dividend income nearly doubles, from $755 to around $1,500 or $125 a month. Not bad for a strategy that runs on autopilot, right? And it only gets better as time goes on. Let's tie this all together with a real-world example, step by step. Sarah has $25,000 to invest. She splits it just like the breakdown above. $15,000 in VDIGX, $5,000 in DVY, $5,000 across 5 dividend aristocrats. She sets up automatic dividend reinvestment and tucks away an extra $200 each month. Year 1. She earns $755 in dividends and reinvests every cent. Her regular contributions mean she's adding $2,400 more by the year's end. Year 5, the snowball's rolling. Her portfolio is worth roughly $45,000, and her annual dividend income is closing in on $1,500. That's twice what she started with, all while being diversified and not glued to stock news. Year 10, thanks to compounding, reinvesting, and the steady increases from dividend growth companies, she's generating nearly $2,400 per year in dividends, about $200 per month. At this point, her investments cover multiple recurring bills every month. Now let's bust some common myths that hold people back. Myth 1. Dividend investing is only for the rich. False. As you just saw, even a $25,000 start can kick off real progress. Myth 2. High yield is always better. Definitely not. True wealth comes from sustainable, growing dividends, not chasing risky stocks with unsustainable payouts. Myth 3. You must pick stocks yourself. Wrong again. With the power of ETFs and automated investing platforms, you can have professional-level diversification and management with a single click. Myth 4. You have to watch the market every day. Nope. The system works best when you set it, forget it, and let the market and the companies do the heavy lifting for you. What about protecting against risk? With any investment, your main goals are diversification and sustainability. That's why it pays to spread money across ETFs and a handful of blue-chip companies. If a company cuts its dividend, you feel a small dip, not a disaster. Quality dividend ETFs often remove or rebalance out troubled companies before they hurt your returns. Another way to protect yourself: don't over-concentrate in a single sector. The ETFs mentioned above cover hundreds of stocks from various industries. Even in tough markets, this kind of portfolio provides real staying power. One thing people overlook with dividend investing is the psychological benefit. Knowing that money is flowing into your account, even during rocky markets, offers a sense of security and control. You're less likely to panic and sell at the worst time, which is one of the biggest mistakes new investors make. Plus, watching those dividends increase year after year is incredibly motivating. It's proof your money is working as hard as you are. How to get started today. Starting is the hardest part, so let's make it simple. Step 1. Open a brokerage account that lets you buy ETFs and stocks with low or zero commissions. Step 2. Choose your dividend growth ETF, like Vanguard Dividend Appreciation, a yield-focused ETF, and a short list of blue-chip dividend aristocrats. Step 3. Allocate your $25,000 according to your risk comfort and set up dividend reinvestment. Step 4. Automate monthly contributions. $200 if you can swing it, but any amount helps. Step 5. Sit back, watch the dividends roll in, and resist the urge to tinker every week. Most people overestimate what they can do in a year and underestimate what's possible in a decade. Dividend investing isn't about flashy short-term gains. It's about building wealth that lasts step by step, rain or shine. With time, the compounding effect accelerates. In 20 years, reinvested dividends and steady contributions could turn your $25,000 into $100,000 or more, with dividend income to match. Not vampire level, get rich quick, but bulletproof against life's surprises. To recap, the average person start living off dividend income, and $25,000 is much more powerful than it seems. If you focus on quality, reinvest diligently, add a bit extra regularly, and let time work its magic, dividend income can pay your bills, boost your sense of freedom, and bring you closer to financial independence without stress or drama. You don't have to be a stock-picking wizard. You just need a plan and the discipline to stick to it. So, grab your $25,000 or whatever amount you have. Lay the foundation today, because your future self is going to want to travel back in time. If you already own SCHD, the Schwab U.S. Dividend Equity ETF, congratulations! You've got one of the most consistent, reliable dividend machines in the market. But here's the thing. While SCHD is a powerhouse for stability and long-term dividend growth, it's not designed to explode your returns. It's steady, not speedy. So in today's breakdown, the focus is on how to complement SCHD, not replace it, to create a portfolio that's both stable and primed for explosive growth. The goal is to understand how a couple of well-chosen ETFs can balance SCHD's weaknesses and deliver the best of both worlds: reliable income and powerful compounding over time. SCHD tracks the Dow Jones U.S. Dividend 100 Index. It focuses on large-cap U.S. companies with consistent dividend histories, solid balance sheets, and high free cash flow yields. We're talking about names like PepsiCo, Merck, Coca-Cola, Home Depot, and Broadcom, companies that have proven resilience through economic cycles. The fund yields around 3.5 to 4% and has a 10-year dividend growth rate near 12%. Its expense ratio is incredibly low at just 0.06%, with minimal turnover, meaning you're not paying for constant buying and selling behind the scenes. What makes SCHD stand out is its disciplined structure. It screens companies that have paid dividends for at least 10 years and ranks them using metrics like return on equity, dividend growth, and cash flow to debt ratios. Those that make the cut are weighted based on their dividend yields. This structure creates a steady, income-focused portfolio that moves slower than the S&P 500 during bull runs, but holds its ground better in corrections. It's perfect for long-term investors who value predictable cash flow and low volatility. However, SCHD's main limitation is its underexposure to growth sectors, especially technology. Tech makes up only around 13 to 15% of its portfolio, while in the S&P 500, it's over 30%. That means investors miss out on some of the fastest-growing segments of the economy, especially in times when innovation drives market returns. To fix that imbalance, two ETFs can work alongside SCHD, funds that inject growth and innovation into your portfolio without compromising its core stability. The first ETF to complement SCHD is VGT, the Vanguard Information Technology ETF. If SCHD is your income engine, VGT is your rocket fuel. VGT tracks the MSCI US Investable Market Information Technology 25/50 Index, which includes nearly every major American tech company, from giants like Apple, Microsoft, and NVIDIA to smaller innovators like Intuit and ServiceNow. This fund delivers exposure to the core of modern economic growth: semiconductors, software, cloud computing, and AI infrastructure. SCHD and VGT balance each other beautifully. SCHD is light on tech, while VGT is entirely tech, so you diversify across economic sectors. Historically, VGT has returned around 18 to 20% annually over the last decade, roughly double SCHD's rate. Even a 25 to 30% allocation to VGT can significantly lift overall returns. Though it's more volatile, SCHD's steadiness cushions the swings. Together, they actually reduce total portfolio volatility compared to holding either one alone. VGT's yield is modest, around 0.8%, but its dividend growth rate is impressive. Tech firms like Microsoft and Apple have raised their dividends aggressively, often outpacing traditional dividend stocks in growth. Over time, that helps close the yield gap and adds a powerful compounding effect. If SCHD represents the legacy of corporate America, VGT represents its digital future, and every balanced investor needs exposure to both. The second ETF that pairs brilliantly with SCHD is QQQM, the Invesco NASDAQ 100 ETF. QQQM is essentially a more affordable twin of the popular QQ fund, with identical holdings but a lower expense ratio of just 0.15%. It provides exposure to the NASDAQ 100, the top non-financial innovators driving global markets, including Apple, Microsoft, Amazon, Meta, Alphabet, Tesla, and NVIDIA. QQQM adds explosive growth potential while complementing SCHD's defensive characteristics. SCHD gives you value and cash flow. QQQM delivers growth and innovation. Together, they smooth out performance across market cycles. When rates are high and value stocks outperform, SCHD leads. When liquidity rises and tech booms, QQQM takes over. Historically, QQM's annualized return exceeds 15% over 20 years, proof of how innovation and compounding can dominate in the long run. Think of SCHD as your defensive line and QQQM as your offensive playmaker. The balance between the two is what drives superior long-term results. Now, how do you combine them effectively? There's no one-size-fits-all approach, but the strategy depends on your goals and risk tolerance. For conservative investors focused on income, a 70% SCHD, 20% QQQM, and 10% VGT mix works beautifully. You get solid dividends, moderate growth, and minimal volatility, perfect for retirees or dividend reinvestors. For balanced investors, a 50% SCHD, 30% QQQM, and 20% VGT allocation tends to outperform. Backtesting shows this blend more than doubled SCHD's total return over the past decade while keeping drawdowns manageable. Finally, growth-focused investors who can stomach more volatility might go 40% SCHD, 35% QQQM, and 25% VGT. This allocation favors aggressive compounding, ideal for younger investors with long horizons. The power of this trio lies in its synergy. SCHD smooths the rough edges of QMU and VGT, while those two drive overall performance higher. Together, they create a portfolio that's resilient, yet opportunistic, the kind of setup that thrives in both bull and bear markets. Let's look at performance data. If you'd invested $10,000 in SCHD back in 2013, it would have grown to around $34,000 by 2024, a solid 240% total return. But if that same $10,000 were split between SCHD, QQM, and VGT in a 50-30-20 mix, you'd now have over $61,000. That's almost double the outcome with only about 15% more volatility. It's not just about taking more risk, it's about taking smarter, diversified risk. SCHD's correlation with VGT sits around 0.75, meaning their movements aren't perfectly aligned. That's good. It ensures diversification works in practice. When one lags, the other often leads. The same goes for QQQM and SCHD. This correlation structure builds a portfolio that's less likely to sink all at once during downturns and more likely to capture gains when conditions shift. What about income? Many investors worry that adding growth ETFs like VGT and QQQM reduces their dividends. It's true your starting yield will drop slightly, from around 3.8% with pure SCHD to about 2.5% combined. But your dividend growth rate accelerates dramatically. SCHD's dividend growth is already strong at roughly 12% annually. QM's dividends have grown about 14%, and VGT's a staggering 17%. Reinvesting those growing payouts can actually deliver higher future income than SCHD alone after several years. Cost efficiency is another strength. SCHD charges just 0.06%, QQQM 0.15%, and VGT 0.10%. Weighted together in a 50-30-20 blend, your total expense ratio hovers around 0.09%. You're accessing hundreds of top-tier companies across multiple sectors for less than 0.1% annually, far cheaper than most mutual funds or actively managed portfolios. To keep the balance intact, rebalancing once or twice a year is enough. When tech rallies too far ahead, trim 5 to 10% from VGT or QQQM and reinvest it in SCHD. When value and dividends lead, shift back toward growth. This small, disciplined act of rebalancing helps you buy low and sell high naturally, maintaining a stoic approach that resists emotional swings. Of course, every portfolio carries trade-offs. SCHD tends to lag when interest rates rise sharply because high-yield stocks become less attractive compared to bonds. Meanwhile, QQQM and VGT can stumble when tech valuations stretch too far or when liquidity tightens. The key is that their risks don't overlap perfectly. When one struggles, the other often holds firm. Take the case of David, a 35-year-old investor who started in 2016 with 60% SCHD, 30% QQQM, and 10% VGT. Over 8 years, his average annual return was nearly 14%, beating the S&P 500 and SCHD individually. During the rough 2022 market, his portfolio fell only 17%, less than both SCHD and tech-heavy portfolios. When markets rebounded in 2023, his growth allocation helped him recover faster than pure dividend investors. It's the combination of offense and defense that delivers consistent success. Looking forward, this approach fits perfectly with where markets are heading. The coming years will see alternating cycles of growth and value leadership. High interest rates, AI expansion, energy transitions, and shifting trade dynamics mean the winners won't always be the same. SCHD anchors you in cash flow and financial strength. QQQM captures the innovation driving new wealth. VGT zooms in on the cutting-edge tech infrastructure that powers it all. This blend thrives across regimes: inflationary, deflationary, expansionary, or recessionary. When rates fall, tech surges. When rates rise, dividends in cash-rich companies protect capital.
What if you could wake up every single month to see money already sitting in your account? Not because you worked extra hours or begged your boss. The wealthy don't trade time for money. They make money work for them. You don't need millions or Wall Street experience. Today, we're diving into how 3 specific ETFs can turn a modest investment into a monthly paycheck by 2030. These aren't meme stocks. These are serious income-producing assets, backed by billions and trusted by institutional investors. By the end of this video, you'll know how they work, how much to allocate, and how this strategy can set you free from the 9-to-5 grind. Let's talk about why timing couldn't be better. Something strange is happening in the markets, creating a once-in-a-decade opportunity for income investors. Dividend yields are significantly higher than usual due to market volatility, which fuels income strategies. When markets are uncertain, ETFs that sell options can charge higher premiums, distributing extra cash to shareholders. The more chaotic the market, the more potential income you can make, but this environment won't last forever. Meet JEPI, the JP Morgan Equity Premium Income ETF. It delivers consistent income every month. JEPI boasts $41.27 billion in assets, and it yields about 8.4% annually, meaning $840 a year on a $10,000 investment. JEPI holds around 115 large-cap U.S. stocks, names you know and trust like Microsoft, Amazon, Meta, Mastercard, and NVIDIA. The fund's managers sell call options against those stocks, essentially renting out the right to buy shares at a certain price. If the stock doesn't reach that price, they keep the premium. If it does, they sell for a profit. Over the past 5 years, JEPI has averaged around 11.6% annualized returns, combining strong growth potential with fat monthly payouts. JEPI's monthly payouts are consistent. June, 0.540 cents per share. July, 0.40 cents. August, 0.358. That's why JEPI should make up the backbone of your income portfolio, around 50 to 60% of the total. Now, while JEPI is the powerhouse, you still need a safety net, something that keeps paying even when markets get rocky. That's where SPHD comes in. Officially known as the Invesco S&P 500 High Dividend Low Volatility ETF. This fund is built for one thing: dependable income. SPHD screens the entire S&P 500 to find companies that strike the perfect balance between strong dividends and low volatility. The current yield is around 3.46%. Sure, that's lower than JEPI's, but this ETF plays a different role. Inside SPHD, you'll find companies that are basically dividend royalty. Think Altria, Pfizer, Verizon, Realty Income, and Kraft Heinz. One of SPHD's most underrated features is its automatic rebalancing. Twice a year, it reviews every company it holds. Over the last 5 years, SPHD has returned about 12.08% annually. Over a decade, 8.93% per year. For most investors, SPHD should make up about 25% to 30% of a dividend ETF portfolio. It's here to be dependable, to keep the income flowing. Think of JEPI as the offensive player and SPHD as the reliable defense that keeps your lead safe. Now let's discuss the third piece of the puzzle that boosts your portfolio, the one that turns extra cash into full-on salary replacement. Enter SDIV, the Global X Super Dividend ETF. It yields around 9.64% annually, giving you nearly 10% of your investment back in dividends. This means with a $10,000 investment, you could earn approximately $964 every year, enhancing your income stream. But what makes SDIV truly special isn't just the yield, it's where that yield comes from. Global diversification offers a hidden advantage. Companies are less correlated with U.S. market cycles, providing more resilience for your portfolio. SDIV has paid a dividend every month for 14 years, proving its reliability through economic challenges. It's not perfect. Currency fluctuations and foreign market risks exist, along with a higher expense ratio of 0.58%. SDIV aims to maximize income, and so far in 2025, it's up over 22% year-to-date, while maintaining substantial yields. You've met JEPI, SPHD, and SDIV. Next, find out how to combine them into a plan that could replace your salary. Think of JEPI as the foundation. It should make up about 50 to 60% of your portfolio. With its strong yield, institutional-grade management, and $41 billion in assets, it's the workhorse that's going to do most of the heavy lifting. Next, allocate around 25% to 30% to SPHD. This is your safety net, focusing on reliability and consistency. Finally, put 15% to 20% into SDIV. This is the turbocharger that boosts your overall yield and adds global diversification. Once you've built your portfolio, the next step is where the compounding magic happens. Instead of spending those monthly dividend payments, reinvest them. Imagine starting with $50,000 today and adding $500 a month. By reinvesting, you could generate a life-changing monthly income by 2030. These payments keep coming, whether you're traveling, spending time with family, or just relaxing at home. Every investment carries risk. Dividends can fluctuate, markets can change, and past performance doesn't guarantee future results. It's crucial to do your own research, talk to a financial advisor, ensuring this strategy fits your goals and risk tolerance. These ETFs aren't speculative. JEPI is the largest actively managed ETF. SPHD delivers consistent income for over a decade. SDIV has paid monthly dividends for 14 straight years. These are battle-tested machines backed by major institutions. The window of opportunity won't last forever. Elevated yields, thanks to market volatility, won't be permanent. As volatility fades, yields will shrink. The income streams you can lock in today may not be available in the future. The combination of elevated yields, high-quality ETFs, and consistent monthly payouts is rare. And when those three things align, fortunes are built. Every month you wait is a month you're not collecting income, a month you're not compounding, and a month your future self might wish you had acted. Instead of asking for raises, you'll give yourself one. Instead of worrying about layoffs, you'll build financial security that can't be taken away. Building passive income isn't just about numbers and charts. It's about psychology, about shifting how you think about money. We're taught to trade time for money, but wealthy people flipped that script a long time ago. They stopped asking, "How do I earn more per hour?" and started asking, "How can I make money while I sleep?" They're tools, incredibly powerful tools that take advantage of how the financial system already works. Companies are going to keep making profits. They're going to keep paying dividends. That's why income investing has been one of the most reliable wealth-building strategies for over a century. What does this look like in real life? Let's say you build a portfolio with 60% JEPI, 30% SPHD, and 10% SDIV. On average, that portfolio could yield somewhere around 6.5% to 7% annually, depending on market conditions. That means a $100,000 investment could pay you roughly $6,500 to $7,000 every single year. By the time 2030 rolls around, that income could easily cover major bills or even replace your entire salary. People are quietly collecting monthly checks that rival full-time paychecks without fancy degrees or hedge fund connections. They started now. They didn't wait for the perfect time. The best day to start building passive income was yesterday, and the second best day is today. Every investment carries risk, and dividend ETFs are no exception. Yields can fluctuate, and companies can cut dividends. Spreading your investment across diverse ETFs is key. By building multiple income streams, you ensure stability. Dividend investing is a slow burn, a marathon, not a sprint. While others chase hype stocks, income investors collect checks consistently. Use the market to your advantage and build wealth over time with disciplined, strategic investments. Passive income isn't just about money. It's about options, giving you the freedom to make decisions based on your desires. When your bills are paid by dividends, you get to travel more, work part-time, or start a business without immediate pressure. The earlier you start, the more powerful compounding becomes. Reinvested dividends grow into trees, producing even more seeds. Even small amounts like $100 or $500 a month can snowball into something life-changing over time. Key is consistency. Dividend investing complements other wealth strategies like retirement accounts, rental properties, and businesses, adding a steady income stream. Best of all, it's completely passive. Once set up, the income flows without any additional work. Over the next decade, the global economy is going to change fast. Automation, AI, and new technologies will reshape industries. But one thing that won't change is the value of reliable cash flow. People will still need housing, electricity, food, and technology. Companies will still pay dividends. Investors who position themselves now will collect income long after the headlines change. So where do you go from here? Start small, open a brokerage account, research ETFs, and build your income portfolio. Even if you invest a few $100s, you're setting something powerful in motion. A machine that works for you 24/7. You know the blueprint. You understand how JEPI, SPHD, and SDIV are powerful tools for generating monthly income. It's time to put the plan into action. Every month you wait is a month of income you'll never get back. Most people will just watch and nod. A small group, maybe you, will take action and build their portfolios. They'll reinvest dividends and let compounding work its magic. A few years from now, money will be working for them. If you're serious about financial freedom, the best time to start was yesterday. The second best time is now. If you made it this far, you mean business about your financial future. Hit subscribe for more insights. Like this video if you learned something valuable, and comment on which ETFs excite you for your portfolio. If you've been investing for a while, chances are you've heard of SCHD, the Charles Schwab Dividend Equity ETF. It's the golden child of dividend investors. But here's the thing. What if I told you that there's another ETF quietly outperforming SCHD in key areas? One that could actually give you better total returns, higher growth potential, and still keep that steady stream of dividends. This isn't about hating on SCHD. SCHD is incredible. It's reliable, and it's one of the most investor-friendly ETFs. But every once in a while, something new emerges, something built for the next decade, not the last one. CHD's strategy is clear. It focuses on quality companies with a history of paying dividends for at least 10 years. Companies like Pepsi, Merck, and Coca-Cola, the blue-chip backbone of American capitalism. You get stability and consistent returns. But as good as SCHD is, it has one major limitation. It leans heavily on sectors like industrials, healthcare, and consumer staples. That's where this new ETF comes in, a dividend ETF that bridges two worlds. Imagine holding an ETF that gives you exposure to companies like Microsoft and Nvidia. The biggest challenge for dividend investors in 2025 is balance. You want yield, but you don't want to sacrifice growth. Funds like JEPI or Devo started to change the game. They introduced active management into the dividend ETF space. But this new contender takes it further. This ETF hits the perfect middle ground between SCHD's growth potential and JEPI's juicy yield. It's built for investors who seek to enhance their dividends. CHD offers a stable dividend yield around 3.5%. Respectable and predictable. But this new ETF is boasting closer to 5% in yield. That's a full 1.5 percentage points more in passive income. Over 10 years, this difference can compound into tens of thousands. CHD has averaged around 11% annually over the last decade, while this ETF has been closer to 12 or even 13% in back-tested performance. When you add the compounding effect of reinvested dividends, you start to see real wealth acceleration. But here's what makes this fund special. It's built to adapt. SCHD rebalances once a year based on its index. In the real world, things move fast. Inflation, interest rate hikes, geopolitical shifts. You can't afford to wait 12 months to react. This ETF uses an active or semi-active strategy that allows it to shift weightings between sectors dynamically. That level of flexibility makes it more resilient in volatile markets, which is something SCHD sometimes struggles with. Now, some people might say, but active management means higher fees. And yeah, that's true. SCHD's expense ratio is famously low at 0.06%. But even if this ETF charges 0.35% or 0.4%, the trade-off in performance more than compensates. Think of it like this. Would you pay 30 basis points more for 2% higher returns? Absolutely. CHD has about 100 holdings, very concentrated for an ETF. That's great for conviction, but risky if one sector tanks. This fund spreads its exposure more broadly across U.S. and international equities, giving you a global dividend portfolio. Many investors are chasing yield, flocking to REITs, BDCs, or covered call funds, but many lose value over time. This ETF sustains both principal and payout, meaning your portfolio doesn't bleed value while you collect dividends. If you invest $100,000 into SCHD, you get $3,500 a year in dividends. This new ETF pays $5,000. Over 10 years, SCHD might grow your investment to $285,000. The new ETF? Closer to $330,000. When your ETF pays higher income, it feels good. You're more likely to stay invested and less tempted to panic sell during dips. Let's talk taxes. Holding SCHD's qualified dividends in a taxable account may lead to Uncle Sam's share. This new ETF might offer a more tax-efficient yield through option premiums or capital gains deferral strategies. An underrated advantage is liquidity. This ETF gains traction fast, meaning tighter spreads and easier trading. Traded on major exchanges, this ETF fits into any brokerage or retirement account without hassle. This ETF is for the investor who loves SCHD's foundation but wants more excitement and upside. It's for those building a dividend portfolio to live off dividends sooner, believing in income that grows with innovation. No ETF is perfect. SCHD, JEPI, and this one all have their flaws. Growth slows, payouts fluctuate, and market sentiment shifts. The key is consistency and a strategy that performs across cycles. This ETF excels in that area. In 2025, with inflation and high interest rates, you need ETFs that grow and pay at the same time. This fund's portfolio has well-known top holdings, but focuses on future aristocrats with growth momentum. Investors who master this balance will come out ahead. SCHD will still be strong, but this ETF could quietly become the new benchmark. By the time everyone realizes it, it could already be too late to act. Comparing these ETFs reveals subtle differences that can massively impact returns over time. CHD boasts a 5-year dividend growth rate around 12%, but the new ETF shows similar, even faster growth. Fund inflows into this ETF have skyrocketed, indicating a demand for income that doesn't stagnate. The companies that adapt fastest to the evolving economy will continue to expand profits and dividends. During recent corrections, this ETF showed lower volatility than the S&P 500 and even SCHD in certain quarters. Its structure includes a balance between defensive and growth-oriented stocks. This built-in diversification cushions the blow. In investing, mindset is everything. Many fail because they abandon strategies too early, panicking during dips. Having consistent dividend income changes your behavior. You stop obsessing over day-to-day price movements. This ETF, with its higher yield and stable distribution structure, reinforces a winning mindset. With SCHD, most investors hold it for quarterly distributions. This ETF pays monthly or more frequently, compounding your returns faster. Monthly compounding might seem trivial, but it's like getting paid interest on your interest 12 times, not 4. Over time, that's a serious hedge. CHD has become a crowded trade in dividend portfolios. Its upside is baked into the price, while the new ETF remains under the radar. Early adopters get the best entry points before demand surges. Don't wait until it becomes mainstream or the easy gains will be gone. CHD's heavy allocation means good pricing power, but it leans into sectors benefiting from inflation, balancing with growth sectors. When prices rise, your companies don't just survive, they thrive. That's a key advantage in today's economy. As we consider macro trends like aging populations and rising costs, this ETF stands out by tapping into cash flow shifts more effectively than traditional funds. This ETF is conservative where it matters, but opportunistic where it counts, making it powerful for 2025 and beyond. Income is not just comfort, it's about freedom. For many, it's about building a sustainable portfolio that covers expenses. Imagine a $500,000 portfolio with a 6% yield. That's a potential $30,000 a year, moving you closer to financial independence. Many professional managers now use this ETF alongside SCHD, creating a hybrid portfolio for better returns and flexibility. By diversifying with this ETF, you can achieve smoother returns, fewer drawdowns, and a more adaptive income stream. When you're confident in your portfolio's cash flow, you're less likely to make emotional decisions. That means you stay invested through downturns, keep reinvesting your dividends, and your compounding continues uninterrupted. Investing smartly grows not just your money, it grows your discipline. The reason this ETF is turning heads isn't just the yield or performance, it's what it represents. Investors want smarter income, not just higher numbers. ETFs that can adjust, adapt, and thrive. If you want a pure, classic dividend growth play, SCHD's unbeatable. You're not just another investor. You want to understand where your money goes. You think long-term and value strategy. Do your research, check the prospectus, and understand how this ETF fits your broader goals. Don't follow hype, follow logic, data, and sustainability. If you found this helpful, like, subscribe, and comment your favorite dividend ETF. Keep your money working harder. Stay invested, and I'll see you in the next one. When you think about investing in dividend ETFs, most people get caught up in just one metric, the yield. They see a higher number and assume it's better. But that's not the full story. What really matters is how that yield is generated. Some ETFs juice their yield by using covered calls or high-risk bonds. Those strategies can limit your upside or even erode capital in volatile markets. The ETF we're talking about today doesn't fall into that trap. Its yield is built on genuine, repeatable business performance, companies that earn real profits, pay real cash flows, and maintain their payouts even during rough patches. In today's economy, interest rates, inflation, and supply chain issues mean informed action is needed. Smart diversification isn't just about risk management. You're owning a carefully filtered mix of dividend machines that can thrive across cycles. That's the strategy for resilience. We're not living in a normal economy anymore. Interest rates are up, inflation is unpredictable, and the supply chain is recalibrating. The next decade won't reward passive ignorance. It'll reward informed action. ETFs like this one show smart diversification isn't just risk management. You're not gambling on a single industry. You own a mix of dividend machines that can thrive across cycles. Investing shouldn't feel like a casino. It should be like owning a farm where you nurture and let time work. Historically, portfolios with a healthy dividend component have outperformed those focused on growth in risk-adjusted return. If you're planning for retirement or want steady cash flow in the next 5 to 10 years, that trade-off is golden. Imagine you've been investing $1,000 every month into this ETF for 5 years. You're earning a payout that covers real expenses. That's what I love about dividend investing. It connects directly to freedom you can feel. Stability builds momentum. When your portfolio gives you reliable income, you stop making emotional decisions. Why not design your portfolio to give you income as you grow it? You're accelerating your financial freedom. BIS ETF screens for quality, consistency, and payout sustainability. You're relying on rules that protect your income. If you found this breakdown useful, don't forget to hit that like button and subscribe for more.